Good afternoon, everyone. I hope everyone is doing well and the Monday is going well so far. As advertised, this is a special training webinar that I wanted to host in part as a follow-up to some prior sessions that I have done for some of your agencies, for those of you that are agency personnel that you've hosted for your clients. And in part, I wanted to do this as a follow-up to some of those sessions for anybody that couldn't make it to those sessions if they were live sessions, or for some of those sessions that were done several months ago, to provide an update on the reporting and where that stands, as we're now amazingly in the fourth quarter of 2015, and the deadlines for early 2016 are creeping closer and closer upon us. So for those of you on the session today, first of all, I'm going to do my best to make this a practical and helpful session for you. Whether you are in an agency situation helping employers figure out these new requirements and what to do about them, or whether you are an employer and you've been invited either by me or by your broker advisor, wherever you may be. So those are the groups that are on the session today. Thank you for joining us. And again, I'm going to do my best to make this helpful for you in terms of both an update and refresher on the reporting requirements, as well as some detailed examples and analysis of what the forms look like. And we're going to look at the forms. As we get started, for those of you that are interested in having the forms in front of you, I didn't email them out before the session. Some of you have them handy. I'm going to put the forms on the screen during this session, so there's no need to have them in front of you. But for those of you who want to see them in hard copy, and sometimes I like that as well, to make notes on or just to see and be able to look at your pace rather than mine, you can find the forms upon a quick Google search. They're on the IRS website. If you'll just Google IRS 1094-C, IRS 1094-C, IRS 1095-C. Those are the two forms, and you can pull those up and have them or print them out and make notes, whatever you prefer. But I'm going to show the forms on the screen and even go in the forms and use some sample examples of scenarios that employers are going to have as they complete the forms after the data is available for 2015, complete the forms and get ready to submit them to employees and the IRS in early 2016. So I'm going to go ahead and provide a couple of slides here just with some quick refresher on the reporting, and then we're going to go straight to the forms. I don't have a lot of slides here today, and the slides are relatively meaningless. I just want to use those as a guide since we're in the webinar format today, and the primary focus is going to be on the forms as we go. As always, your questions are welcome. I've got a list right now of some frequently asked questions that I'm going to get through and mix in during the session. But in addition to those frequently asked questions, your questions are welcome, and I'll get to them as many as I can, and we'll have a special question and answer session at the end. But you can issue your questions through the control panel on the right side of your screen at any point, and those questions will come to me, and I'll do my best to get to them. Before I get into the reporting, I want to say just a few quick words about the big news from the last 2 weeks, and that is that, as all of you likely know by now, certainly the advisors on the call and some of you employers that may be affected by this, and those are particularly employers in the 50 to 99 range, Congress 2 weeks ago passed the first item of legislation in 2015 that modifies or improves the Affordable Care Act. We've been waiting for this type of change all year long. We finally get it at the end of September and going into October. Congress passed the law. The PACE Act is what it's known as, Protecting Affordable Coverage for Employees. The PACE Act modifies the Affordable Care Act to allow all states to choose their own definition of small group for purposes of the insurance carrier rules and the insurance rating rules for fully insured plans. So effectively, this protects the way we've always done things when states had the opportunity to use their own state small group definition. The ACA was going to mandate a uniform definition of 100 for all states beginning in 2016, and that's the reason why we've seen a lot of early renewals again and plans that were going to be affected by this rating change, again, particularly those in the 50 to 99 range. We were seeing the October 1 renewals, the November 1 renewals to avoid that. With this change, states can, if they elect to do so, revert back to the 50, if that's what they've used in the past, the 50 definition instead of 100. And states are doing that. North Carolina's already made a change. Other states, like South Carolina, for example, who had not made a change to move to 100 for 2016, can just sit back and continue to use 50 as they had planned to do. So the big deal is that, for employers in the 50 to 99 range, they will not have to comply with the new rating requirements that under 50 groups still have to comply with. So that's going to be a big help to a lot of employers in that 50 to 99 range. Really no impact for large employers over 100, really no impact for employers under 50, but in that mid-range, there is an impact. Now, one reason I mention this today is that there is some confusion around this change because some people have read incorrectly since the news was made public 10 days or so ago, and then the president signed it into law last week, that this has some type of impact on the employer mandate and what employers have to comply with player pay and reporting. And that is not the case. This is entirely a state small group definition rule that applies to the rules that carriers have to follow in individual states as mandated by state law, and then also the way that premiums are calculated based on what groups. As an example, small groups under 50 in every state now, as mandated by the ACA, have to follow the ACA community rating, the age banded rating, where premiums only vary based on age, geography, or tobacco use. Same thing in the individual market. Under 50 groups still have to utilize that if it's a fully insured plan, but 50 to 99 groups in states that recognize 50 instead of 100 as a small group standard will not have to do that. So no impact on the employer mandate, no impact on reporting, only an impact on rates, and only for a certain segment of groups. But I mention that because this is, first of all, it's big news. I'm thrilled that we've had a piece of legislation that improved the ACA, and we need more. As an example, a lot of you have been asking questions recently about the Cadillac tax, and even though we're still a couple of years away, it's not scheduled to take effect until 2018. Certainly, it could have a huge impact on our industry. Momentum seems to be building for modification, delay, or repeal of the Cadillac tax. As of today, I feel like the Cadillac tax is no more than 50% likely to take effect in 2018 in its current form. I feel like the chances are at least 50-50, if not more, that the Cadillac tax is going to be significantly changed, delayed, or repealed by the time we get to 2018. My hope is that we'll see that change happen in 2016, so we won't even get into 2017 to the point where employers would need to start making modifications to prepare for the Cadillac tax. But that's where we are. So a brief word there, an update in terms of the news and what people are talking about as we revert back to kind of the issue of the day in terms of reporting. Now, as a brief word of context before getting into the gory details on reporting, and just an item of refresher. Again, if we were to find reporting on the big map of the ACA, the big map of the ACA and its overall impact on group health plans has several major components, one of which is the employer mandate. Under the employer mandate, as reflected on the slide, we see two items. Number one, player pay. That's what we've been talking about for the last couple of years. The requirement that employers that are subject to player pay either offer affordable qualifying health coverage or be subject to potential penalties. So player pay, which took effect for the first time in 2015 for employers that during 2014 had at least 100 full-time employees plus equivalents. And player pay will apply in 2016 for employers that during 2015 have at least 50 or more full-time employees plus full-time equivalents. As the standard drops back to 50, 100 was just a transition rule. Now, reporting also is under the employer mandate on the big map of the ACA, but there was no 100 transition rule for reporting. So where we are with reporting and answering the question, what employers have to report for 2015, the answer is any employer that during 2014, because we always look back to the prior calendar year, any employer that during 2014 had at least 50 full-time employees plus equivalents. Again, that's determined during 2014. The reason for the asterisk, as listed on the slide under player pay and reporting, is that by transition rule, an employer that was measuring employee counts during 2014 to determine whether or not it had to comply with player pay and reporting could use, instead of the full calendar year of 2014, could cherry pick any consecutive 6-month period. and use a 6-month average or a 7 or 8 or 9-month average instead of a 12-month average. And that's helped a lot of employers get under 50 and avoid these requirements for 2015. Importantly, there's no such transition rule for 2015 and 16. So an employer who's measuring its employees in 2015 to see whether it has to report or comply with player pay in 2016 is going to have to look at all 12 months. So just to clarify, as we get into the details of reporting, the employers that have to report for 2015 are those that had in 2014, whether using a consecutive 6-month period or the full calendar year. And the way to do it is monthly averaging. You count the full-time employees in a month, count the equivalents in a month, add them together, and then average with the other months to get the count for the 6 months or the 12 months. An employer that in 2014 had 50 or more full-time employees plus equivalents. If the employer did, and it could not get under 50 in 2014, then it has to report for 2015. But if the employer was able to get under 50 in 2014, consecutive 6 months or more, then that employer is exempt from reporting in 2015, even if the employer went over 50 during this year. That may affect next year, but it didn't affect this year. This has been the cause of unbelievable confusion from employers, and understandably so, because as an example, let's say you've got an employer that had more than 50 full-time employees plus equivalents in 2014. So that employer would be looking at 2014 to determine its size, and it was over 50. That employer is then going to report for 2015, the calendar year, and the reporting is due in early 2016. So we've got a staggering of 3 years are involved in 1 year of reporting. So, it's just a world we're living in now. It's complicated, but it is what it is. Nothing about this slide, nothing about these deadlines or measurement methods has changed. It's all exactly the way it's been since the final guidance was released on the employer mandate in February of 2014. So we've had plenty of time to learn this, but it is still causing mass confusion for employers. My recommendation for an employer before the end of the year and before the final work is done on reporting is that if the employer has any meaningful chance to get under 50, to take the time to go back and do the calculation for 2014 data, FT plus FTEs. And if any of you employers on the session or any of you advisors need more information to make sure you're doing this right, let me know. I'll be happy to help you. But I would encourage any employer that has a chance to get under 50 to do it, just to make sure whether they are. Any employer that's under 50, you advisors have clients that are exempt. Some of you employers that are on the session today may find out that you're ultimately under 50. My recommendation for those employers is do the math, get it in writing, and document it so that if you ever have to prove it, which you may not, you've got the data from the FT plus FTE calculation for 2014. Now, one other quick word before I move forward, and that is for those employers that were over 50 in 2014 but under 100. So these employers are having to report for 2015, but they're exempt from player pay and any penalties. There is a way to report that to the IRS on the forms, and I'll show you today, that basically communicates to the IRS, we are an applicable large employer, we do have to report, but this is informational only for 2015 because we're exempt from player pay. There's a way to indicate that on the reporting, and not only is there a way to do it, you have to do it in order to be exempt from any penalties and be exempt from player pay in 2015. So please feel free to share your questions on that topic. For some of you that know this very well, I'm sorry for repeating myself. I'm absolutely a broken record, beating a dead horse on this topic, but I just see every single day of my work confusion and frustration from employers on that particular topic. So I wanted to make sure to mention it. Now, as we get into reporting basics, I'm going to give you just some quick refresher. First of all, just to acknowledge this, everybody on this session is at a different point with reporting. Some people have been studying this all year long and are very much up to speed on it. Some are just getting up to speed here in the fourth quarter as we lead into the end of the year and the deadlines in January and February. So we're all at different points. So even if you're a beginner, that's fine. I want to give you some items of refresher today. And even those of you who have been studying all year, I hope that you'll maybe pick up a couple of tidbits today as we figure out how best to help employers. Some employers are going to do this reporting themselves. Most are going to outsource. But whether the employer does it themselves or they outsource, the employer is going to have to be involved. First, the employer's got to be involved in the data tracking and accumulation process, and either getting that to a third party or maintaining that internally. And second, the employer is going to have to review the forms, even if the forms are generated and completed by an outside third party who may assist with the generation of the forms, populating the forms for the employees, and then even potentially submitting them to the IRS. The employer's got to be involved. Much like the W-2, W-3 process, which all of us as employers are familiar with, and the IRS has designed this process to largely track the W-2, W-3 process. Those of you who are in charge of the W-2, W-3 process know that unfortunately, we as employers can't just get the W-2 from the payroll provider and give them to employees. I mean, we have to review them. We have to make sure they're correct. And my discussions over the last few months, particularly with large employers, have indicated that, number one, the employers do review the W-2s and they take responsibility for them. And we've got to do the same thing with these forms. Now, again, as I've already mentioned, the reporting is required for all employers that were over 50 in 2014. So we're all on the same page there. Even the employers that are exempt from player pay this year, if they were over 50 last year, still got a report. The reports are due in early 2016 on the same deadlines as the W-2, W-3. The employees have to be provided the employee statement, which is the IRS 1095-C. 1095-C is the employee statement. It has to be provided to those employees by the end of January. And January 31st is a Sunday in 2016, so employers actually get until February 1st to provide the 1095-Cs or the W-2s. And then the IRS submittal, which is one copy from the employer to the IRS, along with copies of all of the employee statements that are provided, is due to the IRS by the end of February, and it's a leap year, so that's February 29th, or by the end of March if that submission to the IRS is done electronically by the employer, which all employers have to do if they're issuing more than 250 forms to employees. And then a lot of the third-party entities will be doing it electronically and taking advantage of that additional 1 month deadline. But the two forms that we've got to get familiar with if we're employers are the 1095-C, which is the equivalent of the W-2, and the 1094-C, which is the equivalent of the W-3. One popular question: we've got two or more entities. We've got one business, so to speak, but we've got more than one tax ID number, more than one formal tax entity is involved. Which entity is going to do the reporting? The default is that each, and the requirement is that each tax ID number provides separate reporting. So particularly in a situation where you've got two or more entities under common ownership and as a control group together, they're subject to the employer mandate and reporting. Each tax ID is still going to provide the 1094-C to the IRS and the individual 1095-Cs to employees. Each entity, just like with the W-2 and W-3, is going to claim its own common law employees. So each entity will file the reporting, even if, let's say, two commonly owned entities, one has 1,000 employees and one has 3. Well, if they're commonly owned, the 3-person company is subject to the mandate, is subject to the reporting, and it's going to do its own 1094-C and provide the 1095-Cs to the 3 full-time employees, the same way the large entity is providing them on behalf of the 1,000 employees. And that's true even if those two entities are on the same health insurance plan, that each tax ID number is still going to provide its own report to the IRS and to the employees. Another question is, which employees will receive the 1095-C? And this is an issue that's causing some frustration among employers. One difference between the W-2, which is given to all employees, all common law employees that earn any common law wages during the tax year, the 1095-C is only going to be given to employees that had full-time status for at least 1 month during 2015. So any employee who was a part-time employee, was not full-time, was a short-term employee, was a who never worked long enough to have full-time status or be eligible. Those types of individuals, or a third example would be a variable hour employee who's hired or is in a measurement period for the full year but never qualifies as a full-time employee. Those individuals will not be required to get a 1095-C. So the key is, was the employee full-time for at least 1 month. And I think another practical, helpful way to think about it is, was the employee eligible for our health plan during 2015, or should they have been eligible if we had been following the 30-hour rule that the ACA requires? So we can come back to that later, and I'll answer some questions, but that is a topic that's causing some frustration for employers. And frankly, I think that's going to be a big issue for January. Is we've identified all the employees who worked for us during 2015. We've identified all the employees who worked more than 130 hours in 1 or more months, but which of these employees need to get 1095Cs? And I think that's going to be something that's going to be a big topic of January, and something for us to address as we go. In terms of the forms themselves, the final versions of the forms were released September 18th, so we now have what we need for 2015, and third-party preparers have what they need. Primarily, this is the final 1094C, the final 1095C, and the instructions, which I'll also show when I pull those up on the screen in a moment. But we've got the final forms, so we are where we need to be. Now, finally, I said this in prior months, but I continue to say it because I think it still applies, even though we're getting close to the end of the year. I still think, particularly for employers that are not fully up to speed yet, that the two primary goals are these. Number one, assess the data that's needed. A big difference between, the W-2 given to employees and the 1095C is that for the W-2, largely speaking, the data is what it is. It's been tracked by our internal or external payroll during the year, and so we're largely transmitting the data onto the W-2 and then reviewing it to make sure it's right. With the 1095C, we've got to report to these employees and then to the IRS a whole bunch of data that we've never had to report before, so it's new. And that's data that applies for the full calendar year. And frankly, data is going to be really tough for us to pull together all at the last minute in January if we haven't done it before. So an employer that's just doing this for the first time really needs to assess that data here in the fourth quarter and see what, if any, adjustments it needs to make to ensure that that data is in order. And then secondly, the employer really needs to, here in the fourth quarter, examine its need and potential options for outsourcing. And there are going to be some employers that do it themselves. Employers can absolutely fulfill this requirement by reporting themselves, but a lot of employers will outsource, whether to a payroll vendor, to a bin admin system, or to a third-party preparer. And in those scenarios, that employer is going to really need to make sure here in the fourth quarter that they're on track with the data that the third party needs now and will need, and then the process for how that's going to work. We're all doing it for the first time, so obviously it's a new thing for all of us, but I think that's the other key goal here in the fourth quarter. On this slide, I list the primary, the basic categories of data that is needed. First, for the 1094C, which is much less data intensive than the 1095C that we're going to give to employees. But the data for the 1094C, most of it's just employer specific data. We are going to need the two key items to be tracked are the number of full-time employees for each calendar month, effectively, which employees that are getting 1095Cs were employed full-time in the particular months during 2015. And then there's also a request for the total number of employees for each month, and I'll show you where those are on the 1094C. Largely today, I'm going to focus on the 1095C for two reasons. Number one, this is really where all of the data is, and all of the, I think the focus is going to be for employers in terms of the data and the 1095Cs being prepared correctly and reviewed by employers in January before they're distributed. So number one, the 1095C is really what the big deal is. And then secondly, the 1094C, we've got more time for that because the 1095Cs have to be completed with all the data there and distributed in January. The 1094C, we have at least 1 month, if not two, in some circumstances, additional to prepare the 1094C, which is much less difficult, and then send that to the IRS. So we'll largely be focusing on 1095C. And you can see there just the basic data. The short story is that for everybody we employ in 2015, we need to know, what months were these employees employed? For the months that they were employed, were they full-time? If they were full-time, were they offered coverage? If so, what was the cost of the coverage? If they were offered coverage, did they enroll? Did they waive? If they waived, was the coverage affordable under the 9.5% rule in any available safe harbors? As I'll show you in a moment on the 1095C, self-funded plans have to report more data. They have to report not only whether or not the employee was offered coverage and whether or not he or she enrolled, but in a self-funded plan, you've got to report every individual that enrolled, spouse and dependents, along with their Social Security number, the months they were covered. Fully insured plans don't have to do that because the carrier is doing it on their behalf, and I'll show you that as we get to the forms. Self-funded plans have to report more data. The good news is, whether fully insured or self-funded, we're talking about the same two forms. It's just that self-funded plans have to provide a little more data, since the carrier is not legally required to do so the way it is for a fully insured plan. This slide includes a quick overview of what employers have to report specifically. Again, employers that were under 50 are exempt. That could be an under 50 employer with no health plan in 2015, or an employer that was under 50 in 2014 and had a fully insured plan this year. No reporting is required. There is an exception in that self-funded plans have an obligation, since there's no carrier involved, to report enrollment. So we could have a small under 50 self-funded plan that's exempt from the 1094C, 1095C, but that employer would have to have a limited obligation to provide the B series, the 1095B to employees, 1094B to the IRS, just for the people who enrolled, employee, spouse, and dependents. That's somewhat rare, but I want to mention that just in case some of you have some small group self-funded plans. I mentioned whether you're fully insured or self-funded, the employers will use the same two forms. The reason for that is that even though self-funded plans have a larger reporting obligation, as I mentioned, the carrier is doing part of the reporting. That's the 1094B and the 1095B, which the carrier has to provide for fully insured plans directly to the employee, directly to the IRS. The employer has to do nothing. So the employer does not have to transmit that data. So that's very helpful from an employer standpoint to emit that data. The carrier is legally obligated to do it directly. For a self-funded plan, since there's no fully insured carrier in place to do the reporting, the employer will have to do it, but we don't have to use the B series. We can just provide the same data to the IRS and to employees on the 1095C and avoid, having to provide separate plans. So just a quick overview there. And I'm not going to go through these, but I've got a more detailed slide for each group size in case that may be helpful to you, and I'll provide that to you along with the slides. I'm going to hit a couple of quick questions now before giving you an update on some of the last couple of weeks. One of the questions is, looking ahead to 1/1/16, an employer who in 2015 has 50 or more full-time employees plus equivalents, would the penalties begin in 2016 if you had more than 50 in the prior year, and any certification required? Yes, this model that we are learning to live with here, this 50 or more, is going to apply for each year. So as I mentioned, if we were 50 or more in 2014, we've got to report for 2015. Regardless of our status for this year, if we have 50 or more this year in 2015, we've got to report and comply with player pay in 2016. The way that we're going to report an exemption this year in that 50 to 99 range is on the 1094C that we give to the IRS, that indicates that we're doing the reporting, but we're exempt from penalties. Where I think your question is asking is, if an employer was under 50 in 2014, so it didn't have to do the reporting, didn't have to do player pay, but then goes over 50 this year, what will that employer do in 2016? They'll just report as normal. There's no certification required for the under 50 groups. So nothing needs to be done there. Looking through the other questions. Yeah, there are a couple questions on waiting period and some of the things I'll get to. I'm going to put up the forms and go through a couple of examples here right now. Before I do, last background information before we look at the forms. I mentioned that the IRS recently released the final forms, and that's what we're going to be looking at today. A couple of other quick updates. In case you haven't read this, one of the common questions I get, and I've got it on my FAQ list, is what are the potential penalties for employers? What should we be worried about? The key that I want employers to know there is this: what we're trying to do is do our best with the reporting to get the reports completed, get them to the right employees, file them with the IRS on time. All of the penalties that are outlined by the IRS relate to an employer not filing. As an example, over the summer, in a separate release, the IRS confirmed that the penalty, which had been $100 per form not submitted, had been increased to $250 up to an employer maximum of $3 million. Now that's just, preposterous, and that's off the scale, especially based on the size that many of you are. But that's an indication of the moral of the story here is we have to file. We can't fail to file, fail to give the 1095-Cs to the right employees, fail to file with the IRS. But if we do file, then we've taken that penalty possibility off the table. And if we do file, but we make a mistake, we indicate an employee as full-time or not full-time for a particular month, and that was incorrect. We put the wrong code, the wrong dollar amount in a particular box of the 1095-C. There's no specific penalty attributed to that. So our key is let's file. Even if it's not perfect, let's get the filing done. Now, we want to be accurate, of course, because it is a tax filing. Someone from the company is going to be signing it, and it's with the usual acknowledgement and affirmation that goes along with these type things. We want to do it right, and the IRS is going to be using these forms to make sure that employers are complying with the employer mandate, and also to make sure that they've got subsidy eligibility right for specific employees. So it's important to be accurate, but that's not where the penalties are. So what we want to do is to make sure to report and know that we're not going to have a disaster based on a specific box or a specific code. So I provide that hopefully as assurance for employers, along with a wake-up call of, we have to do this. Now, I mentioned earlier that electronic reporting is required for some employers. Any employer, whether they're doing it themselves or not, whether the employer is large or small, can generate the forms electronically. The forms that are available right now are fillable PDFs, and I know employers will be using data merge programs and all that. Any employer can generate the forms electronically, but just like the W-2 and the W-3s, some employers, the large employers that are issuing 250 or more 1095-Cs, actually are required to submit those to the IRS in the IRS's electronic system, which is brand new, and it's called AIR, which I think stands for ACA Information Returns, or ACA Information Reporting. The AIR system is brand new. Frankly, from my perspective as a person not very technologically proficient, AIR looks like a monster. And I personally don't know how an employer in a short amount of time without substantial IT resources could prepare itself to do AIR by itself. There's the user guide is out. It's like 100 pages long. This is not just we've completed the forms and now we're uploading to the IRS simply and easily and it'll be done. This is a system that's going to require coding and compliance with all kinds of new rules. If anybody needs to learn more about that, by the way, the IRS has an entire page devoted to AIR and the demos that they've released along with the user guide, etc. I mention that because of this. I think if you're an employer considering doing this yourselves and you're under 250 1095-Cs, you'll have the option to do it in hard copy if you can't use AIR, so no real problem there. I think most employers that do it themselves, in my opinion, will be 50 to 250 employers with mostly full-time employees in relatively standard scenarios, and you can do it in hard copy. Many of you may do that with the W-2 and W-3. For large employers issuing more than 250 1095-Cs, you either need to be outsourcing so that AIR is somebody else's problem that you're paying to help you do it, or you need to start devoting some IT resources to this, because I do think it's a big deal. There is an option to apply for a waiver from AIR for employers that have a reasonable basis to claim a waiver from doing so, and the new instructions include the details on how to apply for a waiver and what specific tax form. But I want to just mention this in advance because unfortunately it's not going to be a simple, complete, and upload process. Now, along those lines, an update on outsourcing. This is a topic that we've been talking about for several months now. Here is a short synopsis of what I'm seeing in my experience. First of all, many employers are outsourcing, and certainly the most popular outsourcing destination is payroll. Employers also have the option to do the forms themselves, which I think a lot of employers will, again, particularly employers that are closer to 50 and have mostly straightforward scenarios where the data tracking really wasn't a big deal. There are independent entities doing this, including several in the Charlotte area that I've had some direct contact with, and one that I've only identified in the last couple of months that I've been very impressed by. That's a very simplified service that really doesn't handle the tracking, but helps the employer know what data they need, and then the independent entity is basically going to prepare all the forms. And I've been impressed with this group. If you need an outsourcing option, either as an employer or as an advisor to talk to your clients about, this is one that I would suggest for the employers, particularly again in the 250 to 250 range with relatively simplified scenarios. There are some entities that handle the data tracking and the reporting and very comprehensive service for employers, whether 50 or 50,000. And a lot of those services, as you know, are very expensive, as are some of the payroll services. So it's just a matter of what's a good fit for the employer. Now, whether it's the payroll vendor, it's this outside entity, the key is that you've partnered with somebody that knows what they're doing. Frankly, my experience as someone working with employers and advisors is that some of the payroll vendors seem to be really on top of this and some do not. And that's not necessarily known in advance according to size or whether it's a local or a national company, because I think the national payroll vendors are struggling every bit as much as the lower, more local entities. And one particular national vendor, I've been on multiple conference calls in the last 2 weeks because the national vendor clearly has set up its system in a way that's just not consistent with what the rules actually are, and it's causing some frustration and confusion among employers. So there's certainly no general analysis that the national groups are really good and the local groups are not. And in fact, the opposite may be true. But without calling any particular vendors by name in this context, I just want to say, whether you're an advisor or an employer, just make sure the entity you're dealing with knows what they're doing. If it's October 2015 and you are paying or are going to pay an outside vendor to assist you with this and they haven't gotten any of your data yet, that's probably an issue. Or if you are paying someone and they've gotten all kinds of data that's way more than actually needed, that's probably an issue as well. So keep that dialogue going. Make sure you've got somebody that you can trust helping you with this, and I'll leave it at that here today. But know that there are options, and among these 4 options that I list on the slide, I think employers are using all 4. The only thing I would add to that is on bullet point 3 regarding independent entities, it seems like most CPA firms are not going to be involved in the preparation of the forms. So even if an employer is tracking its own data and really just needs assistance with the preparation and completion of the forms along with the codes and legal definitions, it appears that there won't be a lot of CPA assistance to do that. Maybe some CPAs get involved at the 11th hour, but I'm not seeing that yet, if that is the case. Just a brief few words there. Now I want to look directly at the forms. I'm going to take a very brief look at 1094C, and then I want to look at 1095C in a little bit more detail. I'm going to flip at this point over to the PDFs, and I hope they'll come up cleanly on your screen. What you should see on your screen now is a copy of the instructions up in the upper left-hand corner, 2015 instructions for Form 1094, 1095C, both for employers who are going to do the reporting themselves and for employers that outsource, but the person at the entity who's going to be reviewing and in charge of signing the 1094C, this is the key document. It's 17 pages, and none of us are ever going to get excited about reading the instructions for tax forms, but as those things go, this is pretty good. It's 17 pages, and they have been updated at least 3 times. This is our guide to how to do the forms, and this is where we know 98% of what we know about the reporting comes directly from these instructions. So I just want to highlight these as a key document. And again, they explain the 1094C, IRS submittal, as well as the 1095C. Now, pulling up the 1094C, which is a 3-page document, and it's going to be submitted 1 copy to the IRS with copies of all of the 1094C. So this, again, is the equivalent of the W-3 that's submitted to the IRS for an employer. I filled this one out in sample form. And if you want to see an example of a sample filled out 1094C versus a blank one, I'll be happy to share this with you. So I filled this out for Acme Inc., an employer that's determined that it's an applicable large employer. So in part 1, it's going to list the employer contact information, including the contact person, which in this example is Mary Jones, with a phone number listed. As we scroll down to the bottom of the form, we see some things we're used to from the W-3. Total number of forms 1095C submitted with this transmittal, I put 105 just as a dummy number here. That means that the employer is submitting one 1094C with 105 1095Cs given to the 105 individuals that were employed by the employer and determined to be full-time during 2015 for at least 1 month. Is this the authoritative transmittal? Yes, the box is checked. That's going to be yes for most employers, just meaning this is the real deal transmission. I get a lot of questions about line 21. Is ALE member a member of an aggregated ALE group? The translation here is there a common ownership group? Is there a control group? Are there 2 or more entities, including Acme Inc., that are commonly owned such that for purposes of IRS 414 and the employer mandate rules, those employers have to be combined together to see whether or not they are applicable large employers? If the answer to that is yes, then yes is checked, and then we flip over to page 3. This is page 3, part 4, and the other entities under common ownership are listed by name and tax ID. If there are no entities, going back to page 1, if there are no other entities under common ownership, then no is checked on line 21, and then that page 3, part 4 is left blank. And if you're an employer and there are some related entities, you're not sure whether they are part of an aggregated ALE group, that's something to dig into a little bit more deeply because it can have other impacts besides just the reporting. Line 22, I mentioned earlier that for those employers that were under 100 full-time employees plus equivalents during 2014, so exempt from player pay this year, but you were over 50, so between 50 and 99 in 2014, so exempt from player pay but subject to reporting, I mentioned that there was a way that employers could communicate that. Well, part 1 of that is this line 22, where that such an employer, or any employer actually, is going to check box C, section 4980H, transition relief. So that's going to be checked by a small or a large employer. Now, flipping over to page 2, just to finish answering this particular question, on line 23, column E over there on the right-hand side of the screen will include either a capital A, as listed on the slide, or a capital B. Capital A indicates to the IRS that this is an employer that was under 100 full-time employees plus equivalents in 2014, exempt from player pay in 2015 due to the transition relief. A, box C on line 22, and capital A in column E on page 2, line 23, must be marked for that employer to get transition relief. Now, for an employer that was over 100 during 2014, subject to player pay this year, that employer would put capital B, and capital B will designate to the IRS that that employer was over 100, subject to player pay this year, but that employer wants to take advantage of the other transition rules, including the non-calendar transition rule, the minus 80 on the penalty. So that would be a capital B. So I'm going to change it back to capital A, but I just wanted to mention that. Now, some other questions are common from employers. What about, and this is something that payroll companies are asking employers about, and I think, you know, my experience so far is that payroll companies don't even really understand these transition rules that are mentioned on line 22. A, B, and D, what is the significance? Well, the short answer is A, B, and D are largely irrelevant for employers, and they just don't even matter. My recommendation to employers is just don't even worry about A, B, and D. Just leave them unchecked, check box C, move on. Line 22 was originally designed by the IRS such that an employer who qualified for A or B could qualify for what was originally called simplified reporting, and then after the IRS realized it wasn't simplified, it's now called alternative reporting. In theory, if the employer met certain qualifications to check A or B, and those qualifications are listed in the instructions, then the employer could, instead of providing 1095Cs to the employees, could provide a simplified statement, basically a paragraph telling the employee that coverage was offered, it was affordable, et cetera, and that the employer would not have to do the 1095Cs for employers. Well, that sounded good, except even if that's true, and even if the employer checks A or B and doesn't give the 1095C to employees, the employer still has to generate the 1095Cs the same it would have to give to the IRS. So because of that, no employers are using A and B, and this alternative reporting is worthless. And I've confirmed that with other colleagues that are working with employers in other areas of the country. The alternative relief right now is worthless. Hopefully that will improve in the future, but for this version of the 2015 reporting, I would suggest an employer don't worry about A, don't worry about B, don't worry about D. Unfortunately, it won't, those items won't help us. But they are listed in the instructions, and some employers would qualify. So if the employer wants to, use that as an alternative method, the employer certainly can. But I just don't think, in my opinion, it really does any good. Now, part two, we don't. Not a lot of data goes in here. The employer can use line 23 and not go month to month if the employer either offered coverage, as shown here with a checkbox yes in column A, or not offered coverage. The employer could just use this line, doesn't have to go month to month. And if the employer does that, well, the lines in column B and C for full-time employees in column B, total employees in column C, would just be an average of all 12 months. And that is the in column B, full-time employees, what employees that are getting 1095Cs were employed in January. It gives us a January number. Same for February. And then those months are averaged through the year. And the instructions confirm that employer arriving at the full-time count or the total employee count can use the first day of the month, last day of the month, the first payroll date, the last payroll date, or the 12th day of the month. All those 5 options are available to an employer. So really not much more to be said there. I will finish the 1094 by saying this. Even though it looks benign, column A here on page 2 is the most important item of the 1094C, because if the employer can certify in column A that it has offered minimum essential coverage to all of the employees that are getting a 1095C, then that's basically communicating to the IRS, we've offered coverage to everyone we need to offer it to. This is not a penalty situation. This is not an A penalty sledgehammer situation. We've offered the coverage we need to offer. So IRS, you can scrutinize it if you want to on the 1095Cs, but this is not a penalty situation. So hint, hint, spoiler alert, check yes for column A on the 1094C. No would be the appropriate answer. For example, if the employer had not offered coverage for the full year or for part of the year, no would be. And the instructions explain, a more detailed definition of column A. But the short answer is, employer, have you offered coverage to all individuals that are receiving a 1095C for the months that they were eligible? So again, that's a very quick look at the 1094C, but I'm going to skip ahead because I really want to get to the 1095C. I'm going to pull that up on the screen now and actually go back just briefly to the slides for just a moment, because I'm going to show you what I'm going to do in the final amount of time that we have together this afternoon. I'm going to go through an example, and for my example, I'm going to use the same employee, John Smith. And for purposes of this example, I want to assign an employee-only total premium of $450. So the $450 is the amount that Acme Inc. is paying to the health carrier for John, $450. John's share of the $450 premium is $125. So John, if he enrolls, is paying $125 with pre-tax salary deductions. If John waives, obviously he's paying $0 and he's not in the plan, and the employer's not paying its $325 share. Now, there are a lot of different scenarios, as you all well know, about what can happen with John Smith during a particular year. What we're going to do is look at the basic 6 or so scenarios that will account for 99% of your employees. And those are those that are employed and full-time all year, whether they enrolled or waived. Those that are hired mid-year, whether they enroll or waive, and regardless of the waiting period. Those that are terminated mid-year, whether they take COBRA or not. And then the situations of non-calendar plans where some employees drop or enroll mid-year due to the non-calendar scenario. And there are other scenarios. You're welcome to ask questions about other scenarios, but I feel like this covers 99% of the employee situations and what we will be dealing with our friends John Smith and the people that are going to get the 1095Cs. Now I'm going to go back to the 1095C. I've already filled out part 1, John Smith's employee information. Over here is the employer information for Acme Inc. On the right. Part 2, employee offer and coverage. This is where it all happens. This is the lion's share of the reporting. Now, every time someone, me included, looks at this form for the first time, and I'll admit to this, looking at the draft form a year ago or however long it's been since the IRS released the 2014 draft, it looks fairly benign. We've got some 3 lines, we've got, a box chart here. This looks like something we can handle. Unfortunately, the reason it's not benign is the amount of data and specificity and legal definitions that goes into Part 2. And there's a lot of information listed in instructions about how to handle Part 2. You'll see, just as we saw in the 1094C, that there's an option to report for all 12 months, this column, the first column, and then an option to go month to month. For situations where John Smith's status was the same all year, and neither whether he was an employee changed, neither his status, neither the cost of coverage, whether he enrolled or waived, if that didn't change all year, we can complete all 12 months. But if John's status changed during the middle of the year, we've got to go month to month and complete all 12 monthly columns. So employers, whether or not you're calendar year or non-calendar year, some of your employees you'll likely be able to do the all 12 months column. Some of them you'll have to go month to month, and that will vary as the examples will show. Now, one thing, if you look here in Part 2, look all the way over here to the right, you'll see plan start month. This is new. This was in the final draft. This was a new change in the final draft of the form. So every employer is going to list its month. This example, we got a calendar year plan, so 01 indicates it's a January renewal. An employer that was July would be 07, or October would be 10. But this is a great change because it gives us the option to communicate to the IRS what month we renew. So for instance, if you're July 1 renewal and you've got a lot of people who you're showing in the month-to-month reports are either enrolling or dropping coverage or cost has changed in July, the IRS will know from the 07 code that you're changing because that's your open enrollment and it wasn't just some type of mid-year change. Now, as we look at line 14, 15, and 16, and I don't want to bore you by looking too long at the instructions, but just as an example, if we look at the instructions, the specific instructions for the Form 1095C begin on page 9, and on the right-hand side of page 9 begin the instructions for line 14. I'm going to flip over to the next page where the specific codes for line 14 are listed, and these are 1 and 9 codes that range from 1A to 1I. Most employers are going to use one of 3 codes, either 1A or 1E for offers of coverage, and I'll come back to that, or 1H for no offer of coverage. There are other codes that apply in some exceptional situations, but for the most part, all employers will use one of 3 codes, 1A, 1E, or 1I. Excuse me, I said 1I. 1A, 1E, or 1H. 1H is no offer of coverage for line 14, and I'm going to come back to that. The instructions on the right for line 15, which asks for the cost of coverage. Here's what it looks like. Employee share of lowest cost monthly premium for self-only minimum value coverage. Translation, for your lowest cost qualifying plan, if you have multiple plans, or your employee only share if you have a single plan, what are you charging the employee on a monthly basis? What is that base rate? That is line 15. And the instructions give further explanation of that. And then line 16 is basically if the employee was offered or not offered coverage, what do we put? What is the code for enrolled? All these codes, going over to page 11, there are 9 codes that begin with the number 2, 2A through 2I. Example, employee enrolled is 2C. 2A was the employee not employed during the month, and we'll use some examples of that. 2B, employee not a full-time employee. If the employee was eligible but waived coverage, the default is that line 16 would be left blank, although there are 3 codes, 2F, 2G, and 2H, if the coverage that the employee waived was affordable based on one of the safe harbors, W-2 safe harbor, federal poverty limit safe harbor, or rate of pay safe harbor. And don't worry about specific safe harbors. If you don't know right now what safe harbor applies to your plan, there's plenty of time to figure that out. And some of these things we will be figuring out in retrospect. Now, I mentioned that very briefly. I want to start with examples. My example number 1 from the slide was John Smith is employed all year, full-time all year, offered coverage all year for $125, and he is enrolled. Well, since John's status did not change during the year, we can complete the all 12 months column. The applicable code here is going to be 1E, because, flipping back to the instructions, 1E on page 10 is the code for minimum essential coverage providing minimum value offered to employee and at least minimum essential coverage offered to to dependent and spouse. So 1E is kind of the default offer code. There is a super safe harbor code 1A that applies for an employer that offers coverage to the employee that is below 9.5% of the federal poverty limit. 9.5% of the federal poverty limit for 2015 is $93. So even though an employer is not required to charge less than $93, if the employer does charge less than $93, that employer is in basically ultimate safe harbor. So if your plan is offering coverage to employees in 2015 for less than $93 a month, then 1A is your offer code. If not, 1E is your offer code. And the only way that 1B, C, or D would apply is if you're not offering coverage to spouses or dependents. So everybody else is 1E. So in my example, going back to the form, 1E, we offered coverage. It was not less than $93, so 1E is our code. The employee share is $125. We're going to put that in line 15. And also, John Smith enrolled. And if you recall, our enroll code is 2C. Just as a quick aside here, 2C is not only the code for enrollment, but it's the ultimate trump code. If an employee enrolls in the coverage, then we are good, because it doesn't matter what we charge to the employee. It doesn't matter what the coverage look like. That employee cannot get a subsidy at the marketplace. That employee cannot trigger any penalty on us. So regardless of what we charge, in this case, the coverage was affordable to John, who, let's just say in our example, is a $25,000 employee. The coverage is affordable to him, but even if it wasn't, when he enrolls, that makes the coverage automatically affordable. So 2C is the ultimate trump code. Now, second example, John is employed all year, offered coverage all year. Okay, so 1E is still the same. We charge John Smith $125 all year, but this time John has waived the coverage. So going back to the instructions, again, I mentioned if an employee waives coverage, the default is that we would just leave it blank. But in this example, John has waived, but that coverage is affordable. And so we're going to look, which safe harbor did we use? In this case, we used the W-2 safe harbor. We projected John's W-2 for the year and set the deduction at an amount lower than what we expect his ultimate box 1 W-2 to be. And we provided a buffer. And there are several different ways to do the W-2 safe harbor, but that's 2F. There's a federal poverty limit safe harbor, the same $93 number is 2G. And there's a rate of pay safe harbor that's a special safe harbor for hourly employees that a lot of employers use that have a lot of hourly employees. That's 2H. But in this case, going back to the form, we use the W-2 safe harbor for affordability purposes, 2F. So we're going to put that on line 16, and now we're done for John. Now, third example, this time, instead of being employed all year, John is hired mid-year. So we're not this time going to be able to go through the all 12 months box. We're going to have to go month to month. And that's going to be the case for some of your employees. Now, going back to the codes, I mentioned 1H was a code for not offered coverage. So because John Smith, in this example, I'm going to say John was hired June 1. Well, he was not offered coverage for the first 5 months of the year. For purposes of this example, let's say that John is eligible as a full-time employee immediately upon the date of hire. So now we've offered a coverage. We're going to go back to our default 1E, and I'm going to list 1E through the rest of the year. Through December 1E. That means we've offered John the coverage. Line 15, we're going to leave it blank for the first 5 months of the year. He was not offered coverage, and then we're going to start putting the $125 for the rest of the year. And I know that some of you who haven't studied this reporting so far are saying, oh my gosh, this is terrible. Where do we hit eject? I'm going through this in part because even if you're outsourcing, this is the kind of thing we're going to be doing in January, whether we like it or not. If we've outsourced, we're going to have to review these 1095Cs to make sure that the right people are getting them and that generally that they've been done correctly. And then, of course, if we're doing it themselves, somebody on our team is going to be doing this analysis. So that's the reason for these scenarios, even though admittedly it's not pleasant. Now back to the example, John's offered coverage in June. For June 1, he enrolls. So 2C would be our line 16 code for the rest of the year. And then that's what we do. So this was the example where John was hired June 1, eligible immediately, enrolls for the rest of the year. Next scenario, John, same thing. John is hired June 1, eligible immediately, but this time John waives the coverage. Maybe John has coverage through a spouse. Maybe John decides he can't afford the 125, whatever. He waives the coverage. So again, we're going to go back to our waiver code for W2 safe harbor. That's 2F. And that'll be the case for the rest of the year. Now we're done with that example. Or a twist on that, let's say that the premium was not affordable to John for some reason. Let's just, in this example, say it's $225. Let's say it was not affordable. Again, we're just going to leave, in that case, line 16 blank because he waived it. So we don't put the 2C enrollment code. We just leave it blank. Separate scenario, John is hired June 1, but now we've got a 90-day waiting period. So he's hired June 1, but he's not eligible until September 1. So what would we do there? We would just continue the no offer of coverage 1H code for June, July, and August. No offer of coverage. We delete the dollar amounts because he's not offered coverage for June, July, and August. And then there is a specific code for waiting period. It's actually 2D. Technically, it says employee in a section 4980HB limited non-assessment period. Translation, there are 5 different scenarios where a non-assessment period applies. One of them is the waiting period. So the right code here is 2D. So we would put 2D for June, July, and August. And then let's say he enrolls after the waiting period is over, we would start putting 2C, or if he waived after the waiting period is over, we would start putting 2F. So that's what it looks like for the mid-year hire. Now, and I'm going to try to finish these up briefly to get you on your way. Let's look at a scenario now where instead of hired mid-year, John is terminated mid-year. So John is employed at the beginning of the year. Starting example will be John is employed and enrolled at the beginning of the year, but John is terminated mid-year. So let's just stick with the May-June scenario. So let's say he's terminated May 31. Whether he's terminated on May 31 or during the month of May with the health coverage to terminate May 31. So before May, we're going to put our offer code 1E through May, offered coverage through May 31, 125 for the first 5 months of the year, and enrolled 2C. Obviously, if John waived to coverage, we would put the waiver code for the first 5 months. But in this example, he's enrolled 2C. Now he's terminated in May or May 31st, effective through the end of the month. Now, just a quick clarification. While it's a frustrating result, what the instructions say is that we can only claim an offer or reflect enrollment for a month in which the offer is good through the end of the month. So example, if you've got an employee who terminates May 11 and you have a plan that terminates day of termination, and so John is not able to continue through the end of May absent a COBRA election, we would not show John as being offered coverage for May or enrolled. So note that that's just the way it is in the instructions, and it's frustrating, but that's what the deal is. So in this example, though, the coverage does go through the end of the month, end of May. So we show it offered and enrolled through May. But starting in June, he's terminated. So whether or not he issues COBRA, this should be 1H, not offered coverage, our same no offer of coverage will apply for the rest of the year. And that applies whether or not John offered coverage. And if you say, wait, I thought that was different. I thought it mattered whether or not he offered elected COBRA. That was the case, and that's what for those of you that did workshops early in the year, that's what we were saying, but that changed in the final instruction. So the IRS in the final instruction said, regardless of whether the employee enrolls or waives, you can reflect it as no offer of coverage. So in this case, no offer of coverage, leave line 15 blank, and now we're going to put the code for, going back to the instructions, employee not employed, 2A, employee not employed. And that communicates the IRS that we don't even need to worry about that employee. He or she's not employed, in this case he, not employed for the rest of the year. So that's the deal, and I like it because it's consistent. It doesn't matter whether the employee elected COBRA or not. Now, incidentally, for those of you who have people on COBRA, if you are a fully insured plan and you had somebody on COBRA all year, so they were never actively employed during 2015, but they were on COBRA through the year, you don't have to do a 1095-C for that person, but know that they will get the 1095-B from the carrier since they were enrolled. For a self-funded plan, if you've got somebody on COBRA, you're going to give them either the 1095-C or the 1095-B. It'll be your choice because they were enrolled. And speaking of self-funded plans, you'll see this part 3 at the bottom of the page. A fully insured plan would ignore this. It says if employer provided self-insured coverage, check the box and enter the information for each covered individual. So a self-funded plan would check the box, would enter the information for John Smith, Social Security number, the months covered, Mary Smith, if John had employee spouse coverage, and if he had dependents, they would be listed as well. So a self-funded plan would do that. A fully insured plan will not do it. They will leave it blank. So for you who are working with or handling a self-funded plan, the bad news is you've got to do part 3. The good news is you can do what you need to do on this form. You don't have to use a separate form, and this ought to be the easiest data that you get as a self-funded plan, because you ought to be able to get a quick report from the TPA or the carrier TPA after the end of the year that includes the data on everybody who enrolled, and then just transmit this to the report or transmit it to your third-party preparer. I think the only example I didn't give earlier was a non-calendar plan. So just as an example, let's just stick with June. If this was a June plan and we would put 06, and then we would use this, let's say an employee who was eligible through May but was not eligible for the new plan year, these same codes that are on here would be reflected. If the person is still offered coverage, but we increase the cost as the employer from 125 to 175, we would reflect that on the form after our June 1 enrollment. And then let's say in this case the employee waived it because the employee didn't want to pay the extra $50, or maybe the additional family premium, whatever that was, the employee waived. So we would change that to a waiver code. So no big surprise there with the mid-year enrollment. And while I know I haven't covered every possible example for the 1095-C, I think the ones we've covered will encompass, again, 98 or 99% of your employee situations. One other item, some of you have variable hour employees, and you say, well, what about a variable hour employee if the employee works full-time hours, let's say 130 hours a month or more during a measurement period? Will we have to report that person as full-time? And the answer to that is no. Until the person has completed a measurement period and has average hours that qualify him or her as full-time, we don't have to show them as full-time and give them a 1095-C. But if the person does qualify, finishes a measurement period, let's say mid-year or in time to be eligible for any of the months in 2015, then that person will be full-time. So a person is deemed to be part-time while they're being measured, and then once they qualify, they're deemed to be full-time, or once they fail to qualify based on a measurement period, then they'll still be considered part-time going forward. So that's one other question that has been coming up a lot recently. I ended up, in the interest of time, going through that really fast, so I'm sorry for flying through the details there. Here's what I'm going to do in the interest of time. I know that some of you need to go, so what I'm going to do is this. I'm going to kind of finish up here with the slides and the 1095-C. Those of you that need to go. One thing I didn't mention earlier, I am going to provide a copy of the recording of this session to you, everybody that registered for the session, in case it's helpful to you later or to a member of your team. You're welcome to share it. I'll provide a copy of the updated forms as well in case any of you do not have them. So those of you that need to go, that's fine. Those of you that have submitted a written question or want to stay and submit a question, feel free to stay now. I'm going to keep the forms posted here, so if I can go back to them if I need to answer a question. But feel free to hang around. And if you do hang around, I would request that you open your question box. You can undock it from the control panel and expand it, and I'll try to respond to all of the questions so that you can all see them. But thanks for joining me today. I hope that it's been a helpful session for you, and I hope that your situation is a good one relative to reporting. We're going to keep talking about this. The education process is going to continue. Even if we don't get a lot more data from the IRS for the rest of the year, and we may not, the education process is going to continue in the fourth quarter and in early 2016, and we're certainly all on the same page in terms of getting this figured out. So any questions are welcome now through the question box or later. For those of you that are going to be signing off now, thanks for joining us today. For those of you going to be hanging around, I'm going to go radio silent here in just a moment, and I'm going to be answering those questions in writing. Feel free to submit any new questions, and again, expand your question box so that you can see replies. Thanks for joining us. Have a good afternoon.